Well, welcome to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at highrockcapital.ca. I'm Scott Tomlinson, and joining me is my partner and colleague and the founder of High Rock, Paul Tepsich. So what we like to do each week is talk about our three models and any important updates with them about what we see happening in financial markets, in the global economy, and the world of wealth management, and what we think might be important, but not necessarily mainstream or front page news. Well, something that we have not talked about for a while is share buybacks, where a company sitting on cash or perhaps borrowing decides to buy back their own shares with the added benefit of pushing the share price higher and not only making shareholders happy, but likely also padding the chief executive officer's bonus that is based in part on the share price. Well, it has become an issue because corporations are spending money doing this, which is very short-term in nature rather than taking a longer-term view to spending on investment in future development. Well, in the most recent share buybacks spike was in the most recent quarter, I should say, share buyback spiked, and it's eerily familiar to what happened back in 2007. And when we look at what happened in regards to the equity market or the stock market back then, it is quite interesting. And this is something obviously that continues to present warning signals for us. Paul, any comment?
Yeah, I mean, share buybacks are, in general, a pretty good after-tax way of giving back cash or cash flow back to shareholders. Quite frankly, better than dividends. But as you said, Scott, there are two problems with it. Number one, it kind of tells you that these companies don't have anything else to invest in their businesses. They may not have a great outlook, whether it's for political reasons or economic reasons. They don't seem to really want to be investing in their business for the future. So that's not great. And the other thing, as you said, and what shows up here is that, it's a great form of distributing cash flow back to shareholders when you're doing so at a depressed stock price. But as you can see here, these companies are doing this at completely elevated stock prices. Doesn't make a lot of sense to me.
Yeah, and further along that line, the corporations have been doing a lot of borrowing, right, to buy back their shares.
Yeah. So this is the amount of U.S. investment-grade corporate bonds that are outstanding right now, and as you can see, it's just gone straight up since the credit crisis back in 07, 08, 09. There's been a huge amount of issuance, even year to date. In fact, the investment-grade market has not performed all that well on a year-to-date basis. A lot of it because these huge, large-cap investment-grade companies have been issuing debt. Companies, I can't remember the first time that Apple actually issued debt, but they did so to buy back stock. So they are levering up, increasing leverage on their balance sheets to buy back stock. It's not necessarily all coming from cash flow.
And certainly when interest rates were low, it may have been, and as you said, stock prices low, it makes sense. But as interest rates rise and the cost to the corporations of issuing create higher debt service issues, right? So that in and of itself becomes problematic because the leverage that they're using becomes more expensive.
Yeah, it's more expensive. It could become problematic for some issuers if they're levering up too much and business starts tanking. Then they're in trouble.
Yeah, and
stranded debt.
Sure, and that's what the fear would be, is that if we are at the late stage of the economic cycle, as we've been talking about for a few weeks now, I think that being at the late stage of the economic cycle probably isn't the best time to be burdening yourself with excessive debt at higher interest rate levels. Also, corporations have been issuing their high yield notes, but certainly not to the same extreme as the investment grade, right?
Yeah, high yield bonds. In fact, you can see over the last almost 3 years, it kind of peaked out around 1.4 billion outstanding in U.S. high yield, and now we're around 1.25. So, in fact, I can tell you even over the last month or so, maybe 6 weeks, the U.S. investment grade market was actually getting pretty soft, yet the high yield market was holding in very well up until last week when or 2 weeks ago, there was a flurry of new issues and it got a little bit soft, but it's still holding in extremely well due to lack of supply. A lot of these high yield issuers in the U.S. are obviously smaller companies and also much more domestic in nature. So they really haven't been issuing near as much. These are companies that typically wouldn't issue debt to buy back stock like these big, large cap investment grade issuers.
Right. Well, as I said before, all of this comes with the fact that we think we're now in the late stages of the cycle, and investors who are buying are more confident, but certainly prices are expensive, and we think it's more of a prudent time to be taking less risk. Okay, so on a more administrative note, we'll soon be sending out our quarterly reports, but we thought it might be interesting to quickly look at the performance of the benchmarks that we use for comparison on a combined basis for a total portfolio. We look at those year to date. Basically, global equities, and we use the All Country World Index as our benchmark, and that's the All Country World Index ETF. Well, it's basically flat on a year-to-date basis. And the TSX, again, on a combined basis, has been a small contributor. And even bonds have been small contributors to the portfolio. But certainly on a combined basis, on a 60-40 portfolio, that return to year-to-date has been less than 1%. So that's something that when you get your quarterly reports, you'll be able to compare your returns year-to-date to the combined returns. And we know you'll find that your returns are in all likelihood, especially if you've been longer-term clients, are going to be significantly better. And that's because we've been able to avoid a lot of the equity market volatility that we've seen in the first half. Paul, any comments?
Not on that one. It's obviously we've written about it in our blogs and we've spoken about it on this video, and our clients will get their quarterly letter shortly. But equity markets globally have had a reasonably tough go. There are pockets in North America, or certainly in the U.S., that have done reasonably well. Most that being the Nasdaq, quite frankly. Europe is down anywhere from 2 to 7-8%. Year to date, European stock indices, and Asia, a notable standout has been China, which is down about 15% year to date. So it's not been a big bull market year to date. That is for sure.
All right. Well, thanks for that. All right. Well, that's it for this week. We, as always, thanks for taking the time to tune in. We certainly appreciate that you're doing that. We love getting your feedback, and we want you all to feel free to send questions if you have some time. Paul's away next week on vacation, so we shall reconvene here again in 2 weeks. But until then, we hope that you continue to enjoy the summer.